We'd like to welcome everybody to our virtual Stone Barn Speaker Series. My name is Ward Keever. I am the president of Covenant Wealth Strategies. Today is October 21st, 2020. And we have a lot going on in the world around us today. In case you weren't aware, we are living in the middle of a global pandemic. We also are in the middle of a very contentious election season, with the election now less than 2 weeks away. There are debates all around us about whether we should have the kids going back to school or not, whether we should be going back to the office or not. And let's just say that it's an emotionally charged environment in which we are living. And so today we are going to be entertained and encouraged and educated on the topic of protecting ourselves from ourselves and emotional investment decision making, which we can just start off right off the bat by saying probably not a good formula, emotions and investment decisions. But Lexi Macaluso is with us today. Lexi is the Regional Advisor Consultant in the Independent Advisor Division of Columbia Threadneedle. And Columbia Threadneedle is one of the largest asset managers in the world. And Lexi covers Delaware, Virginia, Maryland. And so we're very pleased to have Lexi with us today. Prior to joining Columbia Threadneedle, Lexi was the Creative Production Associate for Global Marketing, and Michelle and I have been fortunate to interact with Lexi several times, and I can tell you that creativity is definitely a strength. A lot of enthusiasm, a lot of creativity. We think you're in for a real treat today. Lexi was born in New Jersey, and growing up, her family moved around extensively for her dad's job, and they actually spent a number of years in Tokyo, Japan. Although I believe, Lexi, correct me if I'm wrong, you did not learn Japanese to speak Japanese when you were there. So
no, I could sing some songs, but no, not really.
And she then her family returned to Duxbury, Massachusetts, where they kind of settled in. Lexi is the second oldest of 6 children, and she graduated from Penn State University. I can hear Bill Lloyd cheering all the way from here, but with a degree in marketing and international business. Lexi has been with Columbia Threadneedle for about 4 years, and in January relocated to Arlington, Virginia. Lexi is engaged to her fiance, Jake, who just coincidentally also happens to work at Columbia, covering Iowa, Nebraska, and South Dakota, but fortunately he's on the internal side, so he doesn't have to commute from Arlington. Jake very wisely proposed to Lexi while they were still in New Hampshire before relocating to Arlington, Virginia, so that Lexi was with her whole family in December when Jake proposed. So seems like a pretty smart fellow right there. Lexi loves to ski and play golf, is pretty good at golf from what I understand. Her favorite food is pizza. And without further ado, we'd like to turn it over to Lexi to learn more about the pitfalls of making emotional investment decisions. Lexi, take it away.
Thank you so much, Ward and Michelle and everybody for being here. I really appreciate it. That introduction was awesome. I really appreciate it. But I really appreciate you all being on here today. We are going to have some fun. But today, our main objective is really to go over some of the behaviors that we have as humans and how they can affect our success as investors. In short, I'm going to show you how to protect yourself from those instinctual emotions that may bubble up into things like money, retirement, or just our happiness. But first, just a quick disclaimer. And then throughout the whole presentation, if any of you have any questions, please feel free to email Michelle. She's going to be filtering those. So if there is a relevant topic that I should bring up on the spot, Ward can swing that in. So feel free to send questions throughout. But so great. So like I mentioned, today I'm going to show you how our brains work when it comes to making these highly emotional decisions. But what does our emotions even have to do with investing? If there's one thing you remember from today, it's this number 3.5 or negative 3.5. This is the difference of how much you will make over a 10-year period without having the help of a financial advisor. It's the number that represents what an average investor makes over a 10-year period. So for example, if you started out in the market as an average investor without any help with $100,000, over 10 years, that equals less, you're making $124,000 less than advisor or than an investor that has help. And that is a huge number that can absolutely be prevented. Now, I'm not going to spend too much time getting into the weeds, especially when it comes to science. Like Ward mentioned, marketing background, more fun, but the reason we do have to dig into our brains is it really has a lot to do with our emotions. We don't reach our full investment potential because our human brain is wired a certain way. Some neurologists believe that we actually have 3 brains, and one or actually 2, and that 2 of the brains actually really come from just the mammals or the animal part of us. So the brain that controls more automatic responses, heartbeat, breathing, controlling muscles, balance, things we don't have to think about. That's our reptilian brain. Now, those are automatic, like I said, nothing you really need to worry about. The central part of our brain is actually called the mammalian brain, and it's very similar to what animals have. So if you focus on instinct and emotions, you think about it, we react similar to how animals react when they're threatened, or when we're threatened, we act the same kind of way. Our instincts kick in and we tend to react without necessarily thinking too much about it. So it's like a visual response to fear, fight or flight. Which brings us to the third brain, the human brain. And this is really what distinguishes us from animals or reptiles. It's our CEO of the brain. And it controls things like critical thought, or it's adaptive learning, or rational thought. And it's what separates us from the animal kingdom. It's reflective, it's slower, it's more deliberate, controlled, and it regulates our emotions so that we can consider the consequences of our actions. But sometimes that human brain just doesn't always take over. Sometimes it really is that mammalian brain, or a part of the mammalian brain, which is specifically called the amygdala. I promise, I really had to study these words. I'm not just good at pronouncing them, but amygdala is part of the mammalian brain, and it takes over when emotions are running high. It houses the part of the brain and it can sometimes hijack or override logical thinking or decisions that we may later regret. There's a psychological evidence that the amygdala also goes into code red mode when it senses danger, and it actually, all of the blood drains from the brain and sends it to our muscles so that we really do react. So I'm sure a lot of you are parents or have loved ones, and if you see someone that you love fall into water and they don't know how to swim, you react. You know, it doesn't matter that your fancy iPhone's in your pocket. It doesn't matter that you're wearing your favorite shirt. You're jumping in there right after that loved one. And that's really the code red instinct. But what's bad is that when we feel threatened, that can take over, and sometimes we can't help but react, especially when it comes to money. So when you really think about it, money, earning it, losing it, it's emotional, you know? So sometimes in a world when we need money to survive, whether it's food, shelter, maybe you just need, a roof over your head. So without it, it would be really hard, difficult to create those opportunities, especially for our kids. So research suggests that our gut feeling is our default decision when making decisions. So we really need to make sure that we're exploiting that CEO critical thinking, and that in times of high emotions that we are better served by that logical and reasoning and not the emotional and gut decisions. So today I will show you how to control or to to see some of those common behaviors that can lead to poor decision making, and even though you may have the best intentions. So like maybe you get dressed for the gym, but then your favorite show is on. You really had the best intentions, but you really need to make sure that you control your emotions and we make the right decisions together. So I'm going to be going over 6 cognitive biases and what common examples of how they may affect you in your life and then in finance. So the first one we're going to do is called overconfidence. And it's great to be confident 100% of the time, but overconfidence can be a form of self-deception, and it can affect the way we make decisions. So I know I can't really see everybody out there, but if you would consider yourself a above average driver, I would ask the room, okay, who here would consider themselves an above average driver? 73% of people would raise their hand. And that's when I would say, all right, who took a statistic class? Who knows the real answer? Because we all know 1/3 of you are above average drivers. Good job. 1/3 are average, and 1/3 are below average. We all can't be amazing drivers. So sometimes that overconfidence, pride, ego can get into the way when it extends to skills or overestimate your skills. There was a study done in 1973, and basically what it says is the more information people have, the more they tend to be confident about their answer. So, but it's false confidence because it's not always kind of translates. More information, the more right you are. In a study they did in 1973, 8 experienced bookmakers were given different amounts or increments of information, and then they were asked to predict the top 5 horses in the past races. So each bookmaker was given different increments of information. One was given 5 pieces, one was given 10, one was given 20 pieces. And what they realized that the more data they received, the more confident they got. So that's that white line. But what they also saw was the more inaccurate they got. So their confidence was going higher with the more information, but their accuracy actually fell. And when you think about the sheer amount of information that we have every single day, you think that we'd all be experts at everything. You know, we must think we're all know-it-alls. Each day, humans actually create 2.5 quintillion bytes of information. And there are 3 million Google searches or billion Google searches every single day. 3 billion, I know, I didn't even believe it. But the power of the internet behind us, it's easy to see how we just think we're experts in just about anything. The same is true when it comes to investing. Today's investors have more access to data points than ever before. And years ago, most people just had access to the Wall Street Journal, and that was it. Nowadays, we have the entire internet behind us, like I was saying, so it's a lot easier to see how people can, or how things can increase our confidence, but not accuracy. Selecting the right stocks is extremely difficult, and it's this type of task that people exhibit the greatest overconfidence. We can even look at different behaviors between genders to prove our point. American women actually self-report that they are 44% less knowledgeable than men when it comes to investing. A study called Boys Will Be Boys then found that men trade their portfolios 45% more than women. And this actually results in them earning 1% less. So because a lot of times men feel like they're more confident in investing, or they feel like they read a lot more, they know a lot more, they trade a lot more, but that actually ends up hurting them. So overconfidence is the first aversion or bias that we like to make sure we point out, because advisors can really help you make sure you know what you know. The second bias is called aversion to loss. And overconfidence is simple and pretty straightforward. Aversion to loss can be a little trickier because it's how we perceive and experience risk. And And here's a classic example. I'm going to give you 2 gain options and then 2 loss choices. So I'm going to say, Ward, you will either get $500 upfront right away, or you can take a chance and get $1,000 or get nothing. What would you do?
I'm a big fan of the sure thing. I'll take the $500.
Yep. So the majority of people will choose to guarantee that gain. All right. Now, what if I said you automatically lose $500, or you can chance it and lose nothing, or lose $1,000? What would you do?
I understand your question.
You're too smart. I can't ask you, but most people will take the risk on the loss. So people will choose to guarantee the gain, but take a chance on the loss. And this tells us that a lot of people are risk averse when they're faced with positive outcomes, but risk seeking when it comes to negative outcomes. Why? Because investors feel the pain of loss 2 to 3 times more than they feel the joy of gain. So it can cause people to sometimes take a little bit more risk than they're actually willing to take because of they're scared of loss. So here's a great example. Aversion to loss is why people keep a large amount of cash in their portfolios. You know, they think it's a safety net. They think it's their little nest egg ready for 25 years when I'm going to retire. So it won't feel like it's losing money because the amount won't go down, but you're not really making money either. Saving money in cash or money market funds essentially loses money over time. It won't feel like it because the cash balance won't decrease, but if your money isn't keeping up with the rate of inflation, then it's actually losing money over time. So imagine you set aside $100,000 for 25 years when you're going to retire. In 25 years, when you actually need that money, that $100,000 is actually only worth $48,000 because the purchasing power gets eroded by time if it's not keeping up with inflation. So sometimes people just are so scared of losing money that they put it all away in this nice little nest egg, but it actually is still losing money over time. So that can be a little tricky. Here's another example. I'm sure we can all relate to this. No matter where you stand politically, you probably remember the emotional roller coaster of 2016. And there was a barrage of sensational media and headlines and news, and everyone got so nervous that in October, we saw $24 billion withdrawn from the market. And then we saw it all pile back in December, $24 billion reinvested. The problem with that is they missed out on that 3.7% return, mostly because they were nervous. They heard all this noise in the media and they got scared and took it all out. But if they just kind of stayed the course, had that long-term vision, worked with Ward, they could have known that staying the course was the best thing to do in this kind of environment. And then you won't miss out on that 3.7% return. All right, so the next bias we're gonna talk about is anchoring. Any questions? Do we got any questions? Pausing, we're good? All right, we're moving. Anchoring is another behavior that influences how we make decisions. And the term anchoring refers to a tendency to hold on to something that we're comfortable with. We allow it to influence our other decisions, the decisions we're trying to make, but sometimes the anchor as a starting point doesn't necessarily have a direct correlation. And so making adjustments or making decisions around it can sometimes get tricky. So Columbia University Business School did this experiment with its graduate students. It had all the students that were participating in this project to write down the 4 last digits of their phone number, and then guess how many doctors there are in Manhattan. Before they knew, they separated them into low phone numbers and high phone numbers. Low phone numbers were like the phone numbers that ended 0000 to 2999. The high ones were 7999 to 9999. And they didn't know that's why they were separated into these high and low groups. They were just told that. And then they were asked to, again, guess how many doctors were in Manhattan. The low group guessed around 16,000, while the high group guessed 29,000. 75% higher, but they made this guess subconsciously because they were called the higher group. So they used their phone number as an anchor, but the phone number obviously has nothing to do with how many doctors there are in Manhattan. Here's an example of an anchor that does help. So look at these two identical houses side by side. They're both in the same neighborhood, both listed with the same agent, same time for $1 million. A buyer, indifferent to which one they want to buy, puts a bid in for $900,000. Now, if you didn't have that two last bits of information when they purchased it for and for how much, obviously we wouldn't know which buyer was more prone to accept this offer. But if you can use those anchors, those two last pieces of information, purchased 2 years ago for $1.2 million, those anchors can help kind of influence you on a given situation. So you can obviously see seller A purchased 15 years ago for $300,000, seller B purchased 2 years ago for $1.2 million. You can probably assume, using these anchors, that seller A is more likely to accept the bid. Anchoring also happens in investing. So the time between we make a decision based on our familiar associations, but take emerging markets, for example. Emerging markets economies are not as developed as the United States. Examples of emerging markets are China, India, Peru, Chile, and people in the United States are hesitant when it comes to investing in emerging markets because they're not as familiar with the other markets as they are with the US markets, or it doesn't seem they could provide the same type of return as a US market would. In reality, the growth potential in the emerging markets, in that one little gray or blue shaded area, 50% of the world's population lives there, and the middle class in China already has overtaken the United States middle class. So there's a huge opportunity within emerging markets, but sometimes we just feel safer because we're so used to the United States. We use this bias and it kind of can affect our investing because we may not look at certain opportunities because we're not comfortable with them. Again, a financial advisor can help you with this and can really help you find those opportunities that you're comfortable with. This is my favorite one. So this bias is called pattern-seeking behavior, which is honestly the most common one too. And it's the tendency for people to constantly seek patterns in everyday life, whether they're there or not. Human brains automatically try to find patterns, and even if they're not there. So let's take a pretty good example. We're all familiar with the game roulette at all the casinos. The common understanding of the game is you bet on evens, odds, blacks, whites, black, red, and it's a 50-50 shot. Now, we all know that the 0 and the 00 green kind of tilted in the casino's favor, but the casinos really started making money when they put up those screens that showed the last 10 to 15 rolls. So somebody would be walking by at the casino and see last 10 rolls were all black, and they go, oh, the next one has to be red. Absolutely has to be red. They're pattern seeking. They're trying, your brain is automatically trying to tell you that there is an answer. It's going to be red next. But you forget that it's still 50-50 odds no matter what. That screen just gives you a false hope or gives you kind of the odds of getting a red the same time, but the decision or a hot hand, it may lead you to maybe take more risk or make a different decision than you would when you know it's still a 50-50 chance. Does that make sense? Cool. So one common area within investing that pattern-seeking behavior can affect you is when predicting the moves in the bond market. So let's try to predict these together. From the 70s to 80s, interest rates climbed from 7% to over 15%. In 1991, interest rates peaked at 15.8. After they peaked, they started to fall. The next 10 years, they went from 15 to around 8, so back down. So investors started to predict a pattern. You know, what can you guess what they thought was going to happen next? Oh, I went down. Sorry, nope.
I think you would go up to 15.8, Lexi, clearly.
And it went down, you know, and then, okay, so now they're going to go up. We're pattern seeking, and it goes down, and it goes down. And investors, the average investor was spending so much time trying to predict what the interest rates were going to do that they missed out on just pretty easy money. The problem is not everyone experienced this easy money because they were so busy predicting these patterns that weren't there. Investors who kept predicting their rates would go down mismanaged their portfolios, and you can see the bond market returned about 4.8, whereas the average fixed income investor only had 0.22 after 20 years. That's impactful, and it's because they were constantly trying to predict, and they thought interest rates were going up. So instead of just enjoying that easy ride, they didn't get as much out of it.
Question for you, Lexi. What about this concept of reversion to the mean in terms of, you know, in theory, things revert to a median or a mean or an average. And so how would you take a look at that? I think, you know, for people who are quote unquote pattern seeking, there's this underlying concept about reversion to the mean. So how does that play in?
I think taking into account averages is different than pattern seeking, because I think if you keep in mind an average, or if you are if you're relating what's happening now to maybe historical numbers, it may come off better than actually trying to pattern seek in the moment. So if we know that interest rates have been going down and you just see historically, you may have been more focused just on historically, they're going down, and that's just kind of what the average is. Whereas if you're pattern seeking, you may just be kind of more so thinking about what's going to happen rather than what's happening right now.
Yeah, I think it's interesting just in terms of investing also. We, of course, earlier this year saw the formal conclusion of a bull market that started in March of 2009. And we would have conversations with people regularly where people would say this can't continue. And the reason is because the average says, right? And so this can't continue, but it did continue for over 10 years. And then almost 11 years. And then it's interesting now because as we read and study, there is definitely a school of thought that says, okay, so you had your bear, 20% decline, which is the definition of the formal conclusion of a bull market.
Yep.
And are those who are describing the current market as basically the very beginnings of a new bull market. And so it's just interesting in terms of there was certainly an event, an extemporaneous external event in the form of coronavirus that caused our market decline, if you will. But now it's interesting to hear certain financial experts talking about this is not just a quote unquote recovery, but it's actually the beginning, it's the front end of an entirely new bull market. Fascinating to think about. Certainly not consistent patterns from the past.
Yeah, and that's something that we definitely want to keep in mind going forward. So great point. Thanks so much. Awesome. So the next bias is called representativeness. Representativeness is very closely linked to anchoring. Consider the information here. What if I told you these characteristics? So I'm going to tell you a little story about Susan, and then you're going to tell me which job is most probable. So Susan is quiet, she's scholarly, and she's passionate about social issues. She graduated from Stanford with a focus in English literature and environmental studies. Which of the following careers is most probable? Susan is a librarian. Susan is a librarian and a member of the environmental organizations. Or D, Susan works in the banking industry. What would you guys think?
Would you like to guess?
Oh, you go right ahead.
Okay. I'd like to buy another vowel. I think I need more information.
Yeah, I think so too. But most times when I do this question in a research setting, 1/3 of subjects will choose A, 2/3 will choose B, which leaves 1% for the correct answer C. Now, remember, this question had to do with probabilities. There are nearly 2 million people in the banking industry, compared to librarians, less than 200,000. Now, if you did a librarian that is also part of an environmental organization, numbers get pretty slim. So the odds of Susan being a librarian and a member of an environmental organization versus her being in the banking industry, it's way more probable that she was in the banking industry. But we all kind of made a choice based on what I represented or what was represented to you. I only gave you a small amount of information. And so, yeah, based on the information I gave you, B does sound like the right answer, but it's just part of the story. It's just a sliver of the story of who Susan really is. How this kind of affects us when we are investing. Let's talk about how focusing on a narrow set of information without considering all the facts can really hurt investors. So I'm going to tell you about a company, and you tell me if you think this is a good investment. Now, just completely ignore the company that's on the screen, kind of gives it away. But this company was founded in 1982, has been successfully in business for over 120 years, so successful that they operate globally with over 250,000 employees. They have business in healthcare, aerospace, they have digital technology, and it's been a household name for a number of years, and pretty likely that you have one of their products in their home. Does this sound like an investment or a company that you would want represented in your portfolio? Sure. Yeah, sounds great. Sure. And most people would say, yeah, sounds like a really great, stable option. But when we really expand our lens and we really take a look under the hood, what if I told you now that the CEO of the company recently came out and announcing that the corporate strategy was significant amount of reorganization, selling off business units, laying off thousands? You know, the company was so short.
Can we hear you, Lexi? Can we hear you? Can you hear us? Uh-oh.
Lexi will be back temporarily. So, Ward, do we have I have one question that has come in you'd like to share?
Sure. So we do have a question that has come in, and while we're waiting for Lexi to get queued back up, what are some ways that familiarity, which was, what are some ways that familiarity has unduly influenced decisions in terms of investment decisions? And so I will go ahead and answer that. So, and I think Lexi spoke to this a little bit in terms of anchoring. So things that we tend to be more familiar with, we're more comfortable with. And so, for example, things such as home country bias. So Lexi spoke about the fact that there are 50% of the population of the world lives in emerging markets, but people tend not to be as comfortable investing in those emerging markets because they're not as familiar with the norms, the cultures. They have never traveled to an emerging market. So familiarity tends to lead to a home country bias, which might be one way to look at it. Another way that we see this manifested in investments is.
Can you guys hear me? Sorry.
We can hear you.
I'm so sorry about that. I'm so sorry about that.
I'm going
All
to
right.
finish up a question that we're answering. I don't know if you could hear us while we were answering, but I'm going to finish this
No, I
up. And then,
couldn't.
okay. Well, we did have a question that came in talking about familiarity as a bias, and I would relay that to anchoring. And
I think that, yep.
So I was just talking about home country bias. There you go. We were just talking about that slide right there. And I would say that we also see this in two other ways from an investing standpoint. One is having to do with employer stock. And so the idea that because I work at a particular employer and I'm very familiar with the employer, and perhaps I have information technically I wouldn't have inside information because, of course, I couldn't be legally investing based on inside information. But we see oftentimes that employees who own company stock own a lot of it. And we refer to that as what's called concentration risk, because not only is your paycheck and your future paycheck dependent upon health of the company, but now your financial well-being in the form of investing is also dependent upon the financial well-being of the company.
Right.
And
then it kind of gets to the conversation of diversification. You know, if you're not diversifying your egg baskets, it's like you said, all your eggs are basically in just one basket, like you're talking about.
Yep. So concentration risk, a lot of risk there. We also see this in terms of 401k. So when people retire from an employer, they're familiar with the 401k that they've used for the years that they've been employed there. And sometimes that familiarity causes them to feel like, you know, it's good where it is because I'm comfortable with that, because I know how to log on and I'm not really managing it, but I'm familiar with it. And so that's another area where we see familiarity. So home country bias, employer stock concentration risk, and then I would add also just the tendency sometimes for people to leave what we refer to as a Hansel and Gretel breadcrumb trail of assets in retirement plans from all the different companies that you've worked with. So we actually developed a terminology here internally, a covenant. You've heard of IRA and Roth IRA and rollover IRA and conversion IRA. We actually refer to a consolidation IRA, which is where you take all the breadcrumbs, all the different baskets that have been out there from your previous employers, and we consolidate. Simplify. Yep. So.
Love it. Yep.
All right. So I built you a bridge there, Lexi. We missed you, but we're glad to have you back.
I appreciate it. I appreciate it. I'm sorry. I know technology, it's part of 2020, but I appreciate you guys being so flexible. But back to the mystery company, right? Who knows what this is, but we sounded like a good company. And then we started looking under the lens and we saw that it just wasn't what we thought it was. You know, the dividend was slashed in half, lost over $70 billion in 2017, and their 111-year run in the Dow Jones Index recently came to an end when they were removed. So the bigger picture would be that you don't necessarily, this wouldn't be necessarily a stock that you would want in your portfolio. Now, this is GE that we're talking about, and I used to cover New York and Long Island, so this is more of a sensitive conversation, but having your FA kind of take some of your ideas, maybe there are some companies that you find that are great, and really helping you utilize them, make sure that they're the right kind of opportunity for you that's going to be successful and really help you thrive in your investing. So recency bias is a tendency for people to focus on what most recently happened. This is another bias that we a lot of times see in investing, but also when you think about work. So think about when an employee performance review, you know, maybe you did something amazing 6 months ago, but then you really did, maybe you messed up something pretty recently and the evaluation's next week. Your boss is more likely to remember the thing you messed up on pretty recently rather than the awesome thing you did 6 months ago, just because it happened so recently. So making sure that you don't necessarily use this bias to kind of miss or make a certain judgment. What this means for investors, in 2008, I'm sure that this is a good example. After the 2008 financial crisis happened, the Fed and the global economy put in tons of measures to really help. They were heroic monetary policy to really help recharge the economy, and they kept interest rates low to encourage people to spend. And as a result, investors had great returns in the decade after the financial crisis. But in fact, it has been one of the longest, strongest bull markets in history. It was for a while. And the issue with that is that investors were way too focused on what happened in 2008, that if you see on this chart, you see that actually only 2 years they saw inflows, and that actually people were redeeming their money out of the market just because they were so scared about what happened in 08 that they thought was going to happen again. And because they were so scared, they didn't invest their money. If they anything, they took it out, and that affected their long-term performance, their ability to get returns. They could have made from 2009 with their investment all the way up to recover to that 259%. But the majority of years we saw outflows. So really just making sure that those recency biases don't affect your long-term investing goals. Which brings me to the present. Anytime there's a blip of volatility, the media goes crazy, investors start getting nervous. But in reality, volatility is normal. It's something that has always been around. It's not new. And we often call this vacation syndrome. So when you go on vacation, you get comfortable 2 to 3 days in, you're sleeping in, you're going out to eat, you're taking a nap by the cabana at noon, you're having an extra drink before 5. And when you get back from vacation, you do the normal things you do, you know, cleaning, cooking, kids, maybe go back to work, you wake up early to exercise, your life continues as normal, but the task seems so much harder just because vacation mode made this getting back to normal so much harder. So 2017 was the least volatile year in like 25 years. So when we had 2019 hit or 2018 and then 20, it felt so much worse. It felt so much harder just because we were coming up from such an easy year. We were coming from vacation mode. So while volatility is normal, it just felt like it hurt a lot more because we weren't used to it. So vacation syndrome is part of recency bias that I think can sometimes really hurt your investing. So what does this mean for your portfolio? Well, would you be happy with a purchase of stock if its performance looked like this? Sure, yeah, looks good, going up. But if you take a further lens back, are you still happy with this stock? The yellow segment was the chart of the portion I just represented in the previously. But with the chart expanded, you can see that over a longer period of time, you may be not as happy with that stock. You know, you really can have your ups and downs, but volatility in general can really affect the performance over the long term, or if it's necessary or not to take the information and make a decision. Financial advisors can really help you make sure that the stock you're investing in, even if you're just focusing on what recent performance it had, maybe recently it's been up, but then you want to take a step back and the FA can help you see, hey, maybe this one's a little too volatile for your risk tolerance, or maybe this doesn't do well in this type of environment. So you really want to look at the whole picture and not just focus in on one portion, maybe even if it looks stellar.
And Lexi, I'll just clarify that FA is speak for financial advisor. So when you
I'm
reference...
sorry, did I use lingo? Oh my gosh, don't mind me. FA, financial advisor, correct, yes. So this is a representation, or one psychologist's representation of a business cycle. And it may reveal the single biggest reason that investors tend to capture only a fraction of the returns that the underlying asset classes and they invest in. So in the beginning, remember I said minus 3.45, that is the number that an average investor underperforms versus the market. And this really shows why. Investors rarely ride out the entire cycle. they get to fear, they get to panic, and they get out, you know. On average, investors actually only commit to an equity product for a little over 4 years, and on average in a fixed income product for a little over 3. The problem with that is that they're getting in and out at exactly the wrong time, you know. So with the top, they're pretty sailing, things are great. It starts getting scary, and they sell at the bottom when things are worse. And the biggest problem is that if they buy and sell at the wrong times, they're missing out on the peak of the investment and the investment cycle, which a lot of the times is right in the beginning. So if they're out of the market, they're not in the market when the cycle starts up again, and they're not able to make back that money because they really locked in their loss. In fact, the biggest gains are super early in a bull market. This chart shows that problem, you know, if you're not invested when the cycle starts back up. The first third of a bull market is typically the most dramatic in terms of returns. So the first third, you're getting 25%, second is 12, third is 13, and while you're still getting returns, and that's great, you're not capturing the biggest portion of it because you got scared and got out at the bottom, and you need to really ride through that whole thing so that you can capture more returns on the way up, the full investment cycle. And that really ties this whole back in, so more just kind of average investor returns versus the market. We touched on this a bit in the beginning with what it comes down to the behaviors and what causes our investors to finally make this. So all of those biases can really affect us both on the equity side and fixed income. You can see the average investor on the equity side, 9.66, market 13, fixed income 0.7, market return 3.48, just because people tend to make these poorly timed decisions at the worst times, you know, really underperforming the market. This is why working with a financial advisor is so important. They can really help you kind of manage those emotions, manage those biases, and really make sure that you are getting all the goals or achieving all of your goals for the future. So here are 5 key areas where advisors can help us overcome these problems. These are 5 key areas where I think, yep, Ward?
Leslie, I got 2 questions, if you can go back a slide.
Oh, of course.
So one question is, the average investor return, and in theory, if you work with a financial advisor, you do better than that, but the average investor is a human being and a financial advisor is a human being. So what's the difference between the financial advisor?
The average investor return, so we consider an average investor not an FA, so you would be separate. Financial advisors are different. But the average investor, this is more so signaling just the average person doing it alone, going out there and just trying to invest, create a portfolio, and get return on their own within equities. The market return resembles more obviously the benchmark return, but that's more closely tied to what returns you would get working with a financial advisor.
So I'm guessing that your data set, so this is of course coming from a firm called Dalbar, and I can see the statement there at the bottom. And so they're basically looking at the difference between accounts that are do-it-yourself, maybe a Schwab or a Fidelity account, versus accounts that actually have a financial advisor associated with the account. So that's how this data is being determined.
Yes.
Thank you.
Of course. Did you have another question?
I did have a question, but I think you actually already answered it, so we're good.
All right. Okay. So back to these 5 places where financial advisors can really help. These are 5 key things. So the first one is long-term focus. So for most of us, long-term goals, aspirations, objectives of big things, they're so far away and they can feel so far away that sometimes future us can seem like a stranger. You know, I used to study in college and I'd be like, oh, I'll get up and study. I'll just wake up early and study. Future me can deal with it. Future me is a different person, you know, and that person feels like a stranger, but she doesn't want to wake up and study in the morning as much as you don't want to study at night. So it's kind of one of those things. Keep a long-term focus, having that financial advisor understand your objectives, understand your goals, keep you focused, and make sure that you're not making any decisions that are throwing your objectives off course. So advisors can help us stay focused on what we want to accomplish. 2, discipline through up and down markets. Creating rules prevent us from making rash decisions that we regret. So you and your advisor can make a game plan of what you, or make a plan ahead of time on what you can do in case of certain situations. Now, in volatile elections you can plan ahead for a pandemic. I didn't see this coming, but just making sure that your advisor knows exactly what your risk tolerances are and what you expect to get out from them. 3 is tax awareness. Now, a lot of people don't even think about this when investing. One of the biggest drags on investment returns, though, is usually taxes. It's by far the most consistent attribution of investing, yet few investors actually take the necessary steps to kind of ease into taxes or to really take advantage of how taxes can help in investing. So advisors have the tools and the knowledge that can really help your portfolio also be as tax efficient as you need it as well. Emotional objectivity. So this is pretty much what we discussed all day. Our emotions are very hard to manage. I always say, Lord, you guys are like part-time therapists when it comes to our emotions sometimes. And making investment decisions are emotional. Like I said in the beginning, money is key to survival. So like a lot of the times you make very bad decisions and it can lead to very bad outcomes. So putting distance between the investors and their money can actually prevent sometimes making those bad decisions that we talked about today. So having kind of a buffer or someone in between, kind of distancing you from your money. No, don't check it every day. Don't look at your fine. Having that financial advisor is like your goalie. That's very important to your emotional objectivity. And then finally, education and guidance. Now, I think Covenant Wealth Strategies especially really does excel at this, really making the role of the financial advisor is to teach and guide you towards achieving your financial goals. We called it like holistic wealth planning, getting all of the things you need. In terms of overcoming emotional guidance is by far the most component that they need to be there. But just having that relationship with your advisor to educate you, to guide you, so that when volatility does hit, you say, oh, I talked to Ward about this. Volatility is normal. This is fine. If it gets to this amount, maybe we'll talk. But having a game plan and really understanding why we make certain decisions and understanding the kind of game plan that Covenant Wealth Strategies financial advisors kind of put you through can make you feel a lot more comfortable, even when you hear noise all over the place from different news outlets or wherever you're watching. But these 5 things, I think, is what makes financial advisors so important when you are investing. Now, this is my favorite quote. The investor's chief problem and even his worst enemy is likely to be himself. We have all met the enemy, and it's us. The good news is that understanding our biggest biases and how we can prepare for the future, we can really get over this, and we can solve this problem. So we can make sure to avoid any big hiccups that are to come. But thank you so much. And like I said, if you have any questions, please feel free to email Michelle or Ward or even me. I'd be happy to help out. But really, thank you for your time today, and let's protect ourselves from ourselves, shall we? Let's do it.
Thank you, Lexi. And if you would flip back that slide for questions, email Michelle. So if we have questions coming in, I have a couple of questions or just comments. One of the things that you said, the first factor was overconfidence, and you talked about how more information leads often to higher confidence, but not necessarily higher accuracy. And I would suggest to you or point out in our experience in our studies, we distinguish between information and knowledge and wisdom. And so there's a lot of information that's out there. There's all kinds of noise There's all kinds of data. To your point, with the internet, with Google, we have access to more information than we've ever had before. But knowing which information is pertinent or relevant, that's what we would call knowledge. And then knowing what to do with the pertinent and relevant information is what we would call wisdom, right? So I would just say, I would say on the one hand, you spoke about having more information has artificially led to higher confidence, but not necessarily higher accuracy. But then, you know, at the end, you talked about the 5 key points, and that's education. And so education is about gathering information, but it's not just about gathering information. It's about discerning which information is relevant.
Information is important and relevant.
Right? So knowledge, and then having a clear understanding of what to do with the relevant information, having a clear understanding of what to do with your knowledge, that's what we call wisdom. And so
100%.
Share that.
I think that's why you really need, and that's why you guys have such a great value proposition, is because you're sifting through the noise. You know, you're finding the relevant points of information and then explaining or educating, hey, this is what we're looking at. This is why, and this is why we're confident with our kind of strategy or our kind of decision going forward, because we know which bits of information actually matter. So.
Yep. So I want to take that and segue into a next point, and you used the phrase game plan, and I would translate that process, and I would say, I would highlight the importance of having a process, right?
Yep.
And I think it's okay to refine your process, because as you go through life, as you have experience and that sort of thing, that you can do course correction. But it's important not to abandon the process. It's important to stick to the process and to refine the process as you go. And so, for example, in our own experience here at Covenant, you know, we developed our protect and advance strategies, which they're not binary. They're not all in or all out. They're incremental, so we can scale risk in or scale risk out. But it's very important to understand that we do that by adhering to a process. And so over time, we fine-tune that process, but it's still a process. And having that sell-side discipline was important earlier this year, and we adhered to our process, and it worked out very, very well for our clients. I think the other thing I would highlight.
And I think just to go off that, it's having someone like you guys to make sure they stick to the process, because it's great. It's all great when you have one, but you need to make sure that you implement it and you stick to the process. And like you said, you can make adjustments, but overall, you really don't want to deviate too far, because that's just going to defeat the whole thing. So defeat the whole process of the process.
Yeah, I agree. So I was going to say, make incremental changes, not wholesale changes, right?
Yeah.
The phrase, don't throw the baby out with the bathwater, is actually historically very interesting, because in Europe back in the, call it 1500s or whatever, they literally would get bathed like once a month or something like that. And everybody, there was an order who got to bathe first, and the last ones that got bathed were the babies. And the babies were small, and the water was dirty, and you didn't even realize the baby was still in there. And so it's a legitimate phrase. Don't make a wholesale, don't abandon everything, right? So make incremental changes, not wholesale changes, to avoid that. The other thing I wrote down was, and Lexi, you just alluded to this, the value of comprehensive financial planning. And that's one of our core values here at Covenant, is because we truly believe that the best decisions, including investment decisions, are made within the context of a complete understanding of our client's circumstances and their goals and aspirations for the future.
100%. I always say, I mean, we have dentists, doctors, lawyers, we have professionals that we go to when we need something. And for some reason, people need to kind of loop up with their financial advisors more often like they do for other things. You know, you guys are a soundboard. You're there for if you have worries, if you have ideas, but the main point is really to keep them on their path for success. And I think you guys nailed it on the head, that just it's a teamwork thing. You guys are well planning together, and it's really a process all together.
Yep, yep. So we've had a number of us here recently that have gone to the dentist, and in fact, we've decided to open our own dentist office. And of course, everybody cringes when they hear that because they're like, you guys don't know anything about being the dentist, right? So obviously, we have not opened our own dental office, but I have, you know, I bought my first stock when I was 7. I've got an honors degree in finance from the University of Delaware. I've been doing this over 31 years. And we also have a team, and we actually, we participated in a program yesterday that educated us on the value of different perspectives and the fact that nobody sees, no two people see something exactly the same way. And so by having a team, and specifically by having our investment team, which consists of a CFA, Chartered Financial Analyst, and 4 advisors that are well educated, and we don't agree on everything. We come together every Monday morning for 90 minutes and have our investment committee meeting where we, you know, hash through and sometimes thrash through conversations about things, but the value and importance of having a team to be able to bring a variety of different perspectives, and that's also why we read a variety of different things. So, you know, for me, my personal consumption of data comes from a variety of different sources that might include CNN or CNBC or MSNBC or Fox News or NPR or PBS or Wall Street Journal. I don't necessarily agree with all those different sources, but I'm reading and consuming those different sources of information to gain the benefit of different people's perspectives. So
you're filtering so we don't have to.
You got it. You got it. So, yep.
I love it.
All right, Lexi, we are right at 5 o'clock. So are there any closing remarks that you have for us before I bring it home?
I apologize for the slight technical difficulties. Sounds like you shifted quite well on that. So thank you for that. But I appreciate you guys letting me present today. Thank you all so much for coming and listening. If you do have any questions, I'm always happy to help. So I look forward to working with you guys more. Thank you so much. Great.
Well, Lexi, we appreciate you bringing this presentation to us, and certainly emotionally charged decision-making, specifically emotional charged investing, is, I think we would all agree, not a good idea in this day and age in which we are living with a global pandemic. Yep, you're doing your job. And even with the elections and everything else, you know, there's a lot of emotion out there, so we're seeking to navigate and stay on course. And so we're pleased with the clients that have given their trust to us. We're working diligently to earn that every day. So thanks to everybody for being on the call. If you do have any additional questions, please feel free to email Michelle at Covenant Wealth Strategies, or call Bill or Randy or Chris or myself here at Covenant Wealth Strategies. It's our honor to serve you, and it's our honor to do our best to answer your questions. So with that, we'll conclude today's program. Again, thank you to Lexi Macaluso, and congratulations on your engagement, and best of luck to you in your married life. It'll be wonderful.
I appreciate it. Thank you so much, guys. Have a good one.
Goodbye.